Sir Isaac Newton was a certified, peerless, and transcendent genius. He unlocked how humanity calculates the physical laws of the entire universe. With his unmatched intellect, he could compute the orbits of massive planetary bodies across the cosmic void with absolute, flawless mathematical precision. Yet, in the spring of 1720, this towering intellectual giant faced a chaotic force that he was completely powerless to comprehend. Enter the South Sea Bubble. This was the legendary, ultimate peak of British speculative madness, where citizens of every social class chased overnight riches. Newton was easily seduced by the escalating hype. He acquired a substantial block of South Sea shares early on, watching their value climb exponentially. Playing the conservative, he sold his holdings at an early peak, pocketing a magnificent profit of £7,000 in physical sterling silver. But as the South Sea stock continued its vertical, gravity poison began to take hold of his mind. Intense envy. He watched his friends and intellectual inferiors accumulate massive, life-changing fortunes in days, leaving his early profits looking completely insignificant by comparison. Unable to withstand the immense emotional pressure of missing the real boom, Newton broke his own rigid discipline and plunged back into the mania. He reinvested his entire life savings at the absolute terminal peak of the bubble, buying right when the speculative frenzy was at its hottest. The speculative bubble burst with terrifying, merciless speed. Within short weeks, the overhyped South Sea Company collapsed, completely vaporizing the public's capital. Newton's hard-earned, lifetime stock investment savings were entirely wiped out. He suffered a massive loss of £20,000, representing over $3 million today. He was financially ruined, not by a lack of mathematical knowledge, but by a complete failure of emotional character and behavioral self-control. In his bitter, defeated retirement, Newton uttered a haunting, legendary confession that would echo through 3 centuries of speculative market history. I can calculate the motions of the heavenly bodies with precision, but I cannot calculate the sheer madness of the crowd. Newton possessed one of the greatest analytical minds to ever walk the earth, yet he proved to be an utterly incompetent emotional investor. This historical disaster stands as the ultimate, definitive proof of Benjamin Graham's most critical, foundational thesis on wealth accumulation. Intelligence in investing is absolutely not a function of raw IQ, high mathematical aptitude, or complex academic achievements. Rather, it is a matter of emotional discipline, psychological temperance, and the unyielding strength of character to resist the herd. The smartest people on paper routinely fail in the markets because they lack the basic behavioral software to control their primal impulses. They fail because they lack the passive temperament required to remain completely inactive when the crowd is running in a blind stampede. The brilliant 17th century philosopher Blaise Pascal once wrote, "A deeply insightful critique regarding the core of human nature." He observed that all of human unhappiness and psychological torment stems from one single, tragic, and universal evolutionary flaw: our complete, painful inability to sit quietly in a room by ourselves without feeling the destructive urge to act. The modern financial machinery is engineered to exploit this restlessness, converting your bias for action into a direct path to ruin. To fully insulate your wealth from this predatory Wall Street machine, you must master a critical, lifelong investor. What does it actually mean to invest versus speculate? Benjamin Graham formulated the boundary with absolute mathematical precision in his 1934 masterpiece, leaving zero room for Wall Street's deceptive spin. He declared that a genuine investment operation is a rock-solid, 3-legged stool, structurally supported by 3 non-negotiable operational pillars. First, it must be thoroughly grounded in exhaustive, objective analysis of the underlying company's balance sheet and operational efficiency. Second, a true investment operation must deliberately and systematically guarantee the absolute safety of your principal, shielding you from permanent capital destruction. And third, it must target a realistic, adequate return, refusing to jeopardize safety by chasing high-flying, speculative market performance. Graham warned with immense force that any financial activity failing to meet these three strict criteria is, by definition, speculation. An intelligent investor calculates precisely what a stock is worth, based on the cold, real-world value of its actual business. A speculator merely gambles that a stock's price will rise simply because some other player is willing to pay more. Why then does the entire financial institution of Wall Street consistently choose to ignore and blur this vital distinction? Why do they enthusiastically apply the label of investor to every single retail trader flinging money at hot, unproven stocks? Because of a simple, dark, and highly profitable truth. Wall Street as an institution makes its fortunes on your transaction volume, not your personal financial success. The financial house does not care if you build wealth. They profit entirely from the transactional friction of constant trading. They generate massive revenue on commissions, margin interest, and bid-ask spreads, quietly siphoning off capital every time you trade. By the late 1990s, this marketing machine converted America into a hyperactive speculation nation, addicted to short-term market movements. Day traders sat at home terminals, buying and selling volatile internet stocks at lightning speeds, mistaking luck for genius. Even entertainment icons became vocal trading pundits, admitting she dumped her stocks whenever she saw red. Claiming her Taurus zodiac sign forced her to react emotionally, she panic-sold positions without looking at the underlying corporate numbers. A 25-year-old waiter boasted of trading 10 times a day, completely abandoning any concept of long-term holding. Financial websites and television networks successfully transformed the stock market into a non-stop, highly addictive, and gamified video game. Stocks became completely decoupled from corporate realities, traded as abstract, pixelated blips on screens based on catchy ticker symbols. In December 1999, Juno Online Services unveiled a revolutionary business plan to deliberately lose as much money as possible. On this declaration of financial harakiri, the hyperactive public sent the stocks soaring from $16 to $66 in days. Meanwhile, thousands of day traders fell victim to bizarre financial dyslexia, committing a devastating error in their haste. They sent the stock of a tiny maintenance firm soaring simply because they mistook its ticker, TMCO, for Ticketmaster, TMCS. To survive this structural madness, Benjamin Graham equips us with his most brilliant, immortal, and timeless psychological metaphor, introducing a legendary partner. Imagine you own a stake in a private business, and your business partner is a deeply manic-depressive man named Mr. Market. Every single day, without fail, Mr. Market knocks on your door to quote you a price for your share of the firm. He stands ready to either buy your interest out completely or sell you an additional stake at his current daily number. Sometimes, his quoted price appears highly logical and businesslike, reflecting the actual, steady progress of your corporate enterprise. But often, his wild emotions get the absolute best of him, driving his proposed prices into complete, unadulterated absurdity. He alternates unpredictably between irrational, wild euphoria and deep, paralyzing depression, with no middle ground whatsoever, living on the razor's edge. But as a rational business owner, you have absolutely zero obligation to agree with his unstable, frantic mood swings. You are entirely free to ignore him, letting him stand on the porch while you evaluate your business based on real results. To witness Mr. Market lose his mind in real time, we must examine the spectacular, tragic history of Inktomi Corporation. In March 2000, shares of this early search software firm hit an all-time peak, gaining 1,900% in 24 months. Mr. Market valued this tiny, unproven company at an astronomical, mind-boggling total of $25 billion on paper. Yet, in its entire corporate lifetime, Inktomi had never generated a single, solitary penny of actual net profits. It had reported a massive loss of $24 million in the previous year alone, rapidly bleeding capital behind the scenes. But Mr. Market was completely blind to these operational realities, swept up in a manic, hyperinflated internet love affair. Then came the inescapable, nightmarish depression. The dot-com bubble burst. Mr. Market fell into a dark, vengeful rage. By September 2002, Inktomi's high-flying stock collapsed to a miserable, humiliating low of just 25 cents per share. Its total market valuation was ruthlessly slaughtered, plunging from $25 billion to less than $40 million. Had Inktomi's business completely vanished? Not at all. It still generated over $100 million in revenue. Nothing had changed about the underlying software technology. Only Mr. Market's highly volatile, unstable psychological mood had shifted. Recognizing this massive, irrational mispricing, corporate executives at Yahoo stepped in. Yahoo announced they would acquire the entire business for $1.65 in cash per share. That buyout price was nearly 7 times the rock-bottom, panic-induced price Mr. Market had quoted weeks earlier. Mr. Market is designed to be your humble, obedient servant. Servant, never your tyrannical master, boss, or emotional guide. By refusing to mimic his erratic behavior, the intelligent investor systematically transforms his madness into massive investment success and personal wealth. Why is Mr. Market so incredibly, universally seductive to our modern minds? The answer lies deep inside our own ancient evolutionary neurobiology and brain chemistry. Modern neuroscience reveals that our brains are naturally hardwired to get us into severe, persistent financial trouble in volatile stock markets. Humans are pattern-seeking animals. In the wild, predicting recurring physical trends was the literal key to our species' physical survival. When a stock price ticks up just twice in a row, your primal brain automatically, on a chemical level, anticipates a trend. Instantly, 2 specialized neurological regions, the anterior cingulate and the nucleus accumbens, ignite with high-energy activity. They flood your brain with dopamine, a powerful neurotransmitter that bathes your consciousness in a soft, highly intoxicating euphoria. You become physically, chemically addicted to your own upward stock predictions, mistaking a rising market tide for personal investment brilliance. But when stocks drop, this chemical high vanishes instantly, replaced by a violent, threatening neurological panic that overrules logic. Your financial loss fires up the amygdala, the primitive brain center responsible for processing survival-level fear, dread, and acute anxiety. It triggers a primal response, treating a temporary market drop as a physical threat to your survival. The legendary, brilliant psychologists Kahneman and Tversky mathematically mapped this exact behavioral pathology in human beings. They proved that the emotional pain of a financial loss is more than twice as intense as the pleasure of gain. Losing $1,000 on a stock inflicts an emotional wallop twice as powerful as making $1,000. This biological pain forces terrified investors to capitulate, dumping their high-quality businesses at the absolute rock bottom. They lose their logical perspective, panicking over minor, temporary market vibrations instead of focusing on long-term cash generation. Do not assume professional money managers are immune. They suffer from these exact same evolutionary biological flaws daily. Wall Street professionals are structurally forced to mimic Mr. Market's moves, trading hyperactively to justify their expensive fees. Under immense quarterly scrutiny, they abandon their analytical standards, marching blindly in Mr. Market's frantic, wealth-destroying footsteps. But as an individual, defensive investor, you hold a massive, unfair structural advantage that professionals can never possess. You have the luxury of complete, total passivity. You can choose to completely ignore the daily, manic price quotations. Imagine tuning your television into the Graham Financial Network, where stock market crashes are celebrated as sales. Outstanding businesses are 50% off. Long-term savers load up on bargains. Recall the wise retired gentleman in Boca Raton, asked if he had beaten the market averages over his lifetime. Who cares? All I know is my investment discipline earned enough to get me to Boca. Physically sign your own investment owner's contract, conquer your biological limits, and subscribe to Leverage Chronicles for the ultimate, unyielding financial edge.